For those lamenting that last beer, that last spicy taco at the Super Bowl party, have no fear. Next year, the Super Bowl is on President's Day weekend. You'll have an entire day to recover. Not many great ads. We'll talk about that. We'll talk about the Super Bowl in general. We'll talk about the Super Bowl indicator, not the world's greatest indicator. We'll talk about some earnings today, but that's not really important. We got some earnings later in the week. I guess the government's going to give us some jobs data today. I don't know. Yeah, not today, but this week. So we'll get some econ data. We'll figure out Friday's rally. We'll figure out why we're in the red here on Monday. We'll talk to Lloyd at 8:35 from Lloyd Financial Group, get his macro take on the market. It's Super Monday on PreMarket Prep. Let's get it started.
The volatility right now is really incredible.
Wow, look at that consolidation on the upper right chart.
You know what we've seen this earnings season? Some of these expected moves get even more violent. This is why I have switched my strategy 10 years ago. And if you're chasing, you're in trouble.
Okay, starting out in the S&Ps, we were much higher. We've sold off, only down 6.5 handles on the session. Just a mind-blowing rally on Friday. The buck down 40 cents after a decent week last week, pulling back 97.01. TLT, well, when the whole world's selling U.S. treasuries, I think your treasuries are going to be down 63 cents, 86.91. USO flat, GLD perky, as well as SLV. SLV doing a little better, up almost 4% at 72.61. And Bitcoin, we got that big bottom on Friday. We extended it. We'll see what happens today. Do we have a long-term bottom in Bitcoin futures? TradeStation, our proud sponsor, born to trade, chart, analyze, customize, all in one platform. Learn more about TradeStation. Let's bring on Triple D here. And first things first, how did the hockey tournament go?
Oh, don't even talk about the hockey tournament. We were in a little bit over our heads, so it wasn't the greatest hockey tournament in the world for us. So we'll leave that there. The girls tried hard, played hard, but the results weren't there. That's happened sometimes. We were a little bit over our head in that tournament. And then how'd the Super Bowl go?
Well, let's talk. Yeah. Boring.
Brentster, come in here for the Super Bowl discussion. Brentster, bring him in here.
Hey,
how was your weekend?
Weekend was good. I went to Chicago to celebrate a buddy's birthday. We surprised him, showed up at his house, banging on the door. Let us in.
Nice. That's always
We had fun, though. We had fun. Got back to Detroit. Detroit is cold still. I left Detroit hoping I could go to another Midwestern city and maybe Detroit wouldn't be freezing when I got back, and that's not the case.
No, this has been like the coldest run I think I've seen in a long time. It's minus 22 here right now. And I mean, we're just getting to a point where this is like, I don't even know if that's Fahrenheit or Celsius because they start to merge. When you get to minus 40, they're both the same. So like people ask me, was Celsius or Fahrenheit? I'm like, does it matter at this point in time? It's this cold. It's been so cold here for so long. Like it's incredible. So usually you get like the odd, you get a day or two that comes above freezing, get a little bit of a melt or something. Now it is just absolutely freezing. There's no snow here even anymore because it's too cold to snow. So we haven't had snow in like a week really. We got a little bit of flurry in on Friday, but for the most part, it's just too cold to snow. But let's talk about the Super Bowl because, you're watching and you're like, okay, you're all pumped up, you get the national anthem was done fantastically and you're all ready to rock and roll. And then you get into it and it's like, it was a little bit of a yawner. Like that's just where I was, the commercials, one thing we talk about those, but I mean, the game itself, Seattle just had the defense going and it felt like it was just a little bit of a boring game. So that's why I'm like, I don't know. It didn't seem exciting.
No, not at all. As far as the Super Bowl indicator goes, it was heavy. The NFC winning is supposed to be good for the market. Overall, that was very dominant in the early part of the Super Bowl, where the NFC was strong. The market would have good years. It's been a little bit more even out since 2000 to current. So not a great indicator for the markets. Before we get into the commercials, probably every year I tell my 2 Super Bowl stories. And one was when I was on the floor in the S&P pit. You know how they do squares, right?
Yeah, sure.
It was $1,000 a square on the final score.
They don't play games. We always did $2 a square in university.
Yep.
$1,000.
So
now it'd be $10,000 if they
I would get 9 buddies together and we get 1 square. Of course, we never won, but and always, it'd always be some trader in the pit that won it, and he'd walk in and $100,000 richer, and boom, And then
I bet those bots on the floor do $1 million a square now. All those bots, Citadel, Virtue, all those bots on the floor now. They got so much money there. They're doing $1 million a square. This bot's taking this one, and then they're trying to high frequency trade the squares too somehow. They're probably trying to find an edge in it. Yeah.
And then
What's
my
second story.
I used to do squares. Back when I saw people. I used to do squares in the office until one year, and Brent's gonna remember this story. I did it in the old Benzinga office. I did squares and $5, 10 squares or whatever. And we had a new girl start. Her name was Laura. Okay. And she came in and on I think she came in on a Friday. She got, she tried out. And then, so I put her in a square, and then she ended up winning a square. So she came in on a Monday and I paid her. And, it turned out that there were 2 people with the same initials. I didn't check, so I can't remember what her initials were, but actually it was another person that won the square and not her. But Brent on
They're all asking what squares are. So can you quickly explain this in 30 seconds? Because then we got to get to stock market talk. But it's 100 squares, basically the digis on the one side for the score, digis on the other side for the score, and you're trying to guess the final score.
Well, you're not trying to guess; just everyone gets a number.
Well, there's no guess.
You're assigned a number.
You pick a square and then they put the digits. So you obviously want 7s and 4s. Those are the good ones.
Yes. Yep.
So whatever the top number up here is one team's and last number in the score. If there's only 1 digit in the score, then it's just that. If it's 2 digits in the score, then it's the last digit
number.
And then over here, this one.
Yeah. One
and
team
this one's the
top,
other team.
One team on the middle, and it would be a matrix. But whatever. Yeah. So I paid her, and Brent fired her, and I'm like, I need that $100 back. I owe that to somebody else. Never heard back. I even had
Fernando call her.
I said after $100 squares for me. I quit doing squares. I can't remember what year that was.
She's gone. She's out of there. All right. Let's get to the markets here. There's not a lot of Super Bowl trades to be had. Like we were saying, it's kind of boring. I actually had DKNG long, and then halfway through the Super Bowl, I sold on Robinhood last night. I'm like, this one's too boring. I don't think it's going to be the runner. What a Super Bowl, man. DKNG must have killed that. See a yawner. So I think all the Super Bowl trades, the anticipatory ones, just wasn't a lot materializing. Was there any commercial, one minute on the commercials? Was there anyone that stood out for you? Unfortunately, I'm in Canada, and I can't get them live. I can see them on replays on Twitter and stuff, but we have Canadian commercials, and the Canadian commercials suck. So let me know if there was one commercial that stood out.
Joel, did you have any? Did you have any highlights?
Coinbase one, and in my family, it was horrible. The Coinbase one.
You didn't like that one. What about Mr. Beast? What did he do? Did he do anything for CRM? What did Mr. Beast do? I never heard. He was supposed to have CRM had hired him to do a commercial so that everybody can realize how great of an AI company that Salesforce.com was. Did anybody see the Mr. Beast one? Did he actually do it? You guys don't even remember. Couldn't have been that good.
I'm sure he did it. They made it a big deal. Salesforce made it a huge deal. For sure.
All right. I'm going to watch that later today. I like Mr. Beast. My kids like Mr. Beast. Like watching him. He's kind of fun, but sounds like may have been more wasted money. Maybe not the next Matthew McConaughey for Salesforce.com. Mr. Beast. Stock's trading up slightly.
Yeah, the Dunkin' commercial was horrible. They were not good. It's not, it's not like the E-Trade baby.
This was all not that great. The game wasn't that great. The game wasn't that great.
The commercial's not that great.
It's getting no more of our airtime.
People love football.
Yeah,
and I just want to tell you one other thing.
So let's talk about the reason for the title of the show, The Hangover. And you can see, well, a lot of people, have drinks at the Super Bowl and they're probably a little bit tired this morning. That's one reason. But the other reason here for this is that I feel the markets are a little bit of a hangover here this morning because we had just an incredible comeback on Friday. So if you look at the S&P, down 3 days in a row, look at the Qs, down 3 days in a row, Tuesday, Wednesday, Thursday. We know the Momo names just got crushed for 3 days. All the Palantir holders from 165 to 132, it felt like in a heartbeat. And a lot of other names down 20, 30% in 3 days. Friday, the relief rally of relief rallies. I mean, Dow Jones makes new all-time high. President goes nuts, tweeting up a storm with 50,000. I've got friends texting, holy, you must be killed in the markets. I saw Dow 50,000 here. And, so obviously, sentiment completely turned on Friday. So, the euphoria goes into Sunday night into the Super Bowl because I'll tell you on the overnight trade, you will not believe some of the prices. Robinhood, the stock, was trading up 8% on Sunday night. Stocks like Nebius, IREN, up 4 or 5% again. This is last night. Those stocks now, actually, they're bouncing a little bit with the S&P in the last few minutes. But, those stocks basically gave it all back. It was just, party time on Sunday night trading, and most of these stocks gave it all back. So I feel like it's a little bit of like, okay, you're having a little bit of profit taking here into the ridiculous rally that we had on Friday. And just think, if you were, underwater, if you were like, getting hit hard on a lot of names, you see these names bounce back 10, 15, in some cases 20% if we include the Sunday night action over the course of one day, you may want to lighten up into that. And I kind of think we saw that a little bit here too. So the question is now, a little bit of a hangover in the market this morning. Where do we go from here?
I told that move on Friday to me was I look at it from
get the charts up. Let's take a look at it.
Yeah. Just from the overnight range, we had over a 200-point range.
Yeah.
And you had
we were
talked
down
about
over 100.
Yeah.
So we can't even look at Thursday's low. You got to look at the overnight low, Joel, from Thursday with the S&P.
Yeah, right here.
We were down another 100 points to start Friday morning. Like we were overnight down over 100 points, another 100. And then by Friday morning, we had gotten most of the losses back. So it looks like, it started. And then the party just continued and we ended up 100. So like you're saying, we rallied 200 points from the Thursday night low in 24 hours.
Yes.
Yeah, it's an incredible run. So if you're buying stocks on Sunday night on Robinhood, you can't wait. You might be chasing a little bit. When Robinhood in the overnight session on Thursday night hits down, I think we saw it as low as like $70. And then it hits $88, $89 last night on the overnight session. It's like, okay, yeah, I get Robinhood was oversold. And we talked about this Thursday, stocks being oversold, and it may have been the capitulatory event. That doesn't mean they got to get all the losses back in one day. So chasing, and we do have a chase upgrade this morning here. Just to mention here, we get Robinhood is getting upgraded from Wolf Research here. And they're putting a $125 price target. They say 50% upside. So, I mean, they're chasing it a little bit here as well. But I don't know. I feel like we're just not out of the woods. I feel like we had the capitulatory selling in some of these names. And maybe that means green light go. We're going right back to all-time highs. But I feel like you're going to get another chance. So I think, just as a trader and an investor, it's always more prudent to be buying into weakness if you're a longer term than to be chasing strength. And Robinhood just literally rallied from the lows about 20% one day. Maybe it gets a break for a second. Maybe not. Maybe it goes straight up another 20%. But I think just, be prudent. Buy dips, not buy rips. That's where I'm at.
Just generally, last week, CC Legator from Options AI, one of our options gurus, our option guru, actually, kind of our only one. Yeah. He was like, we didn't have enough volatility. We didn't go far enough last week. The sell-off last week did not go far enough. He kind of was like, we're probably going to need one more sell-off. We're going to need the VIX to be closer to 30 before we get any maybe substantial capitulation. Yeah. Hard to argue against that, I think, a little bit.
I mean, on some individual names, it probably got overdone. And we know the momentum names, crashed, pretty much. You can talk a lot of these names are down 30, 40, 50% from the highs. The software names pretty much crashed. But there was so many other names that didn't even participate in the sell-off. So this was not a washout. This was simply a rotation from overvalued momentum names into cheap value. And that's what we saw. And, Walmart relentlessly higher here. Over the weekend, I saw somebody tweet out, I didn't look, but they said Amazon forward earnings 22 times. Walmart is now 43 times. I mean, this is getting to be like, really? Do we think Walmart is going to become the king of online commerce here now? Is that where we're taking this to? Like Walmart's going to put Amazon out of business? Because that's what the stock is saying. And I think the stock is just getting to a point where it's a bit overdone. And I said this last week when the stock was 125, it continues to go up. Why does Walmart continue to go up? Because people see the cash flow as stable. People see it as defensive. People see it as safe. I don't know when you're getting these value names trading at these crazy multiples, which is starting to get up to 43 times for Walmart if it's safe. So I think this whole discussion is just important. We went from having a bubble and all these momentum names to bursting that bubble and then just creating a new bubble in value. I mean, and it just continues. Coca-Cola has been up $10, has earnings on Tuesday. I mean, these are stocks we talk about all the time, but these are the stocks that are keeping the S&P and the Dow Jones up. These are the stocks that are like, driving, and holding up the indices to, basically hide the carnage in the momentum names, because it has been carnage in the momentum names. So tale of two markets. Value, unbelievably strong. Growth has been hammered. We had a bit of a reversal on Friday, but, overall value didn't sell off at all. Value just kept going. And I don't even think Walmart's value anymore. Here's the other thing. Is, are these even, like, we always consider these safer staples value stocks. At a certain point in time, some of these value stocks maybe just come up too much. I mean, FedEx, bring this one up. We've gone from nobody's going to deliver anything with FedEx anymore when it went down to $200, back in April. It's now $369 and it's going up in a straight line. I mean, is this the future? This is where we're going here. Now FedEx at all-time highs here. This is the company. This is it. I mean, we were talking about FedEx, obviously losing Amazon business, obviously, different, disruptions possibly happening, drone delivery, different things happening here. And now these stocks are just like, no, we need stocks that make money. It's really crazy how quickly everything has changed since October. Where October it was like growth. Now it's like, no, show me the money market. Show me that you make money right now. We want low PEs, and we're just going to buy these things until they have high PEs. That's where it's kind of started. We've gotten to a point where some of these low PE names are starting to become higher and not cheap anymore.
And I think
Berkshire perked up. Go ahead, Baxter.
I was just going to say, Joel, you had such a good point last week talking about value, Apple and their cash, and the fact that the market is seeming to be punishing AI-related names right now. And you were like, guess who the player that has done the least with Apple, with AI?
It's Apple.
It's been Apple. It's been Apple. So Apple has like a few things going for it right now. It has a pile of cash. It's considered defensive, I think, being a consumer staple. And, they haven't been blatantly, at least, investing so much cash in AI.
I just get the Warren Buffett stuff in the back of my head, though. And it's like, buy good companies at reasonable valuations. Walmart, Apple, Coca-Cola, fantastic companies. These are companies that have been like just unbelievable for so long. But are we like getting to a point of unreasonable valuations on these names? Like, I mean, I don't think Warren Buffett is coming in, and obviously he's retired now. But if Greg Abel has learned anything from Warren Buffett, I don't think these are the stocks he's looking for. Not at this point in time. Like, you're coming in now, and now is the trade. Now is the time to be coming in here and buying Coke and buying Apple. I feel like, honestly, like, I know the momentum names, had a pretty ridiculous rally on Friday. But, I mean, some of these things, like when you're getting software trading 23 times earnings and Walmart trading 43 times earnings, we're getting into a wacky market here. And software has so much more growth potential here. Now we're saying maybe it gets disrupted. Maybe all their stocks or companies are going to go out of business because of AI. And that's the unknown. And that's why this has happened. But what I will tell you is if AI does not displace all these businesses, if it does not disrupt as much as we think it's going to disrupt, some of these stocks are actually screaming buys. And it's not Walmart.
The trend for so long was growth over value, right? And what are we going into our fourth month here?
Fourth month of value over growth.
Yeah. So I mean, look how long the other trend lasted. That lasted years and years and years, right? With the growth dominating for the values. So, we could say that something, that it's already stretched, but I mean, on a numbers basis, but on a time and duration basis, then it really, it hasn't been that long. I just think that what you're seeing is that people just got destroyed in some of these stocks, and they're looking to get out,
They're panic buying defensive names.
Yeah.
We got a panic buying defensive names is what's happening here, and they're going to get punished again, in my opinion. I don't know when the rug gets pulled on these defensive names, but I'm not buying Coke after it just ran 15% in a week, 2 weeks. They don't do this things. Coke will sit there and just play stable forever. It doesn't have these kind of moves. And when they do these kind of moves, it's prudent to ring the register and re-enter when it sells back off eventually. That's kind of where I'm at. So, and I said this Friday too, and I thought the value names maybe would give some back on Friday with the run and growth. It didn't. So it's telling me these stocks want to go higher. And you know what the other thing is? In these value names right now are the momentum traders. The momentum traders have moved on to these names. So you got momentum going on these things now. And the momentum trader doesn't give a crap that Walmart's trading 43 times earnings. They just like that the stock's making new highs every day. So, I mean, that's the driver here. Like me, I try to do the combo approach and say, it's not time to invest in Walmart here. Can you trade Walmart from the long side? Well, it's working continuously here. Yeah, you can. You can trade anything. But just remember, if you start to break down, don't get stuck holding the bag here, because some of these stocks that are trading 40 times earnings here now probably shouldn't be.
Well, Red Bull Max. Yeah, from a technical point, let them consolidate at first, right? They'll stop going up, and then they'll consolidate, and then there'll be some kind
they'll probably go up again.
Well, I mean, I'm looking at that Coca-Cola. Holy mackerel! But
the crazy moves. Pepsi. Look at Pepsi. Look at the Pepsi move. This is Pepsi. The stocks went from in 6 days. It went from 150 to 170. Now go back on the chart, and people because if you're momentum traders, you think this is just normal. It's not normal for Pepsi to have this kind of move. This took a year for the stock to go from 130 to 150. Basically the better part of a full year. And when it was going down, like in October last year, 180 to 130, they don't just go up 20 points in 6 days. This is pure rotation. This is like, oh my God, I'm getting crushed in momentum names. Put me in something safe. They don't think cash is safe. Maybe there's good reasons not to think cash is safe, because we continue to put the printing press on. We're going to drive interest rates lower. I retweet a great tweet this morning here, just to have this conversation. Cash probably is not safe. I want to just read this. And this discussion's important here. I know we got some earnings to get to, but I'm just trying to just kind of where we are. We're trying to lay it all down. So the Kobesi letter. This is a great tweet. The U.S. president has a $100,000 price target on the Dow. The new Fed chair is required to cut interest rates. The U.S. president's talking about $2,000 stimulus checks back in the discussion. The U.S. government is buying $200 billion in mortgage bonds. The new $1.2 trillion funding bill signed and into effect. And Trump is saying the U.S. dollar is doing great after a 10% drop. Own assets or be left behind. This is it. I think he's right. I think this is the concern, is that if I move to cash, well, everything's going to inflate around me here, which it looks like, this is all going to be inflationary. I know there's people talking about trueflation and all this other stuff and all this crap on the internet. You can read anything here. But, you go to the grocery store, and the grocery store prices just continue to seem to go higher. And even if we go we're only have inflation of 0.67%, dude, that's after we just had inflation of 30% in 3 years. So you get 0.6, that doesn't mean prices are going down. It just means they're going up more slowly. This is not great. So I think he's right. I think these do need to still own assets. I think we're seeing that trade. When you're getting out of Momo, they're too scared to go to cash. They're too scared of the U.S. dollar. So they're going to Pepsi. But I think chasing is happening there as well. That's it. That's what I got.
I liked it. Good one. You guys want to go to Hims?
Hims. Go to Hims. And yeah, so we'll take you through the action. So Friday night, I actually put this trade on long. Oh my God, Dennis went long Hims. I put this trade on long for the Super Bowl ad. I was like, it's beaten up. People are really excited on social media. They're really talking about this. So I'm going to just buy the Hims. And then the headline comes out. Literally, this is why I'm a headline trader, folks. This is why I'm a headline trader. The headline comes out Friday night, the FDA intends to take action against non-FDA approved GLP-1 drugs. It's like, oh, shit moment here. I'll say it. That's the OSHIT moment. It's like, okay, that's real bad news. I got to get the hell out of this. So I turned around and just hit the bed. I was like, I'm like right there. I was actually getting ready to leave because my kid's hockey tournament. I was like, I can't leave with that headline. I'm like logging in, trying to get out of this as fast as I can. Log in, please get me in because I just want to sell whatever bet. I get logged in. I see 2170, 2160, 2150. I was like, and then I get logged in. I'm like, okay, I'm logged in. I sell, hit the bet. Literally just get me out. I want out. I sell 2150 out, lose $1.50. Sucks to lose $1.50, but you got to know when you're on the wrong side of the trade. That headline hits, get the hell out. Then more brutal headlines over the weekend. So I bought a 2302 for the Super Bowl trade. Obviously, that got harpooned by that headline. I knew there was risk. We talked about risk. There's risk in every trade. Harpoon, get out 21.5, lose $1.50. Imagine if I still had it. We have 5 points now. So what you've got to do is when you are on the wrong side of the trade, that headline is bad, you've got to take the loss. You've got to move on, cut the loss, and get out. That's what you got to do because so many people refuse to take losses. They're like, oh, it'll come back eventually. Maybe it will, but maybe it won't. Then more brutal headlines for Hims over the weekend. Because FDA is coming after them. So they now scrapped on Saturday. We're not going to even offer the weight loss pill. Great for Novo, great for Lilly. And then there's other stuff happening that Novo's getting sued now, or Novo's going to sue Hims as well. So you have multiple bad headlines here. This storied stock, which this was the storied stock for retail. Yeah, for the better part of a couple of years here. Hims. You saw it in all your social media, your Discord, all that. This story is ending ugly for a lot of people here. I don't know if it's officially over here or not, but holy crap, this company's got problems.
Trading at the lows of the pre-market session, that's down $5. This thing in December was at $65. And now I don't even know if there's anything. I'll have to go to the monthlies here. $65. Let's go to the monthly here. Oh boy. Nothing. Well, it could be on this. Yeah, 1870 was your November 2024 low. The next low is 1605. I mean, if you're long, you can wait for a bounce on it. Still a step down seller, it looks like. It looks like they're not done yet. Offered at the low of the session. Keep an eye on your pre-market low, but it's bad news. And then for the other side of the trade, you got NVO. That's getting a little bit of a pop here. That's up 251. I mean, aren't there any lawyers in Hims? I mean, I'm just kind of flabbergasted here that that they would get blindsided like this. So Novo getting a little.
I don't know if they were being blindsided, and we heard rumblings that the FDA was looking at them last week, so there was risk, and then the headline just hits. So obviously issues here for Hims. I'm not going to give any calls on Hims. I know the retail community is saying buy this dip. This stock's going to be $1,000 stock eventually. Most of that is wishful thinking. Obviously we know, there's a lot of traders on these Discord rooms and social media rooms that, just, never look at risk. They only look at reward, and they're just coming in here and saying, yeah, $18. Oh, I'll just sell it when it gets back to 65. It's coming back. All stocks come back. No, it's not true. All stocks don't come back. The stock market itself, you buy S&Ps, yeah, probably comes back. Always has come back. You buy individual names, go back to 2000. 90% of these crap didn't come back. And I don't know if Hims is crap or not, but I don't know that it isn't crap. So I'd be very cautious just saying it's got to come back. Now it's oversold. Is it oversold? Hell, there's so many names that are oversold. Let's go to Monday.com earnings if you want oversold stuff, because Monday.com has the lowest bar. The bar is on the freaking floor, man, MNDY. And somehow they get under it. The stocks went from $150 to $98 in literally 3 weeks of trading going into this report. 4 weeks of trading into this report. And then they report, we'll throw it to the Brentster here for the Monday.com numbers. Let's see it, because somehow they got under that bar that was on the floor.
Monday reports a better than expected quarter, 104 versus 92. Sales were fine. They beat by about 4 million on around 333 million. Their guidance wasn't great. They missed for both the Q1 and the 2026 guidance. They're expecting quarterly sales 338 to 340 million. Analysts are up at 343 million. For the year, they're expecting sales around 1.45 to 1.46 billion. Analysts are up at closer to 1.48 billion. So fine quarter and maybe crappy guidance from Monday.
Step down seller at the lows of the pre-market session. You are getting into old-time low territory here with Monday.com. And you could be. Yeah, you are actually $5 below the old-time low. Old-time low was at least the data that I have on this. 87.07.
I got 73, Joel. So you're not
I'm
quite
sorry?
there. 73 back in 2022, but you're perilously close to that.
Oh, yeah, you snuck that in there on me. 73.58. Yep.
But the point is taken here. When you have stocks, when you have a bull market and the Dow Jones hitting 50,000, and you have stocks that are making new all-time lows or getting close to all-time lows, you are in a bad stock. Maybe it's not a bad company, maybe the company turned around, but you're definitely in a bad stock. I always say, there's certain sayings that just hold true in all markets. New lows, you gotta go. New lows, write it down. Take your sticky note. No, do it right now. Take your sticky note. Go like this. New lows. Here, I'll write it down with you. New lows. So, because right here is like if you watch 30 seconds of the show, take this point. New lows, you have to go. Right? New lows, you have to go. That means you have to get out. There's no reason. As a momentum trader, you never want to be in a stock making new lows. Even as a long-term investor, you don't want to be stocks making new all-time lows. You get new lows, just get the hell out. There'll be another time to get back in. But when stocks are making new lows, beget more new lows. You don't want to be in these names. We had Chris Banier, a friend of mine for a very long time in the Stock Trader Network room last week, and talking about, he only trades momentum names. And there's so many traders like this, but he's always in the best earnings reports. Does fundamental analysis, going the best companies. Was riding Micron. I don't know if he was riding Sandris, was, writing a lot of those best names and I talk about these names and I'm like, going in, asking what these software names, these stocks that are breaking down. And he's like, you know what he just said? All garbage. That's how you just summed it up. New lows, he's not even looking at stuff like that. He's got to be, strength. The fundies have got to be there, just doing it all. I mean, that's the kind of market we've been in forever. We've been in that market for a very long time. And, when they start turning, you can get along the Walmarts and the Cokes and all these things. And, we can do the fundies and say, oh, they're overvalued and stuff, but stuff stays overvalued for a while. But if you're in those stocks right now, you're laughing because who cares if Walmart's got a 43 PE? We were saying it was expensive at 35 and it's just continued to expand. So, I mean, momentum is everything in this market, both to the upside and the downside.
I'm going to sneak in Cleveland Cliffs here before we go to our guest.
Let's do it. The Brentster, if you have them, I can say. Or
yeah, sure. I got you. Cleveland Cliffs. Yeah, Cleveland Cliffs here reporting earnings. A loss of 43 cents per share. It was better than expected. Analysts were looking for a 60-cent loss. Sales look like they did miss though. 4.3 billion. Analysts were up closer to 4.6 billion. I didn't initially see any guidance. Let me double check the press release here real quick. And they have like shipments guidance for steel, but no like earnings or sales guidance from Cleveland Cliffs. Stock trading down about 3% this morning.
I like steel. And Money Mitch has been doing a great job on her swing trading show on StockTraderNetwork.com. Pointing out a lot of these names. You can see obviously, we've had this rise in industrials. Nucor continues to break out, make new highs. Steel Dynamics continues to break out, make new highs. Then you get Cleveland Cliffs. And I'm like, I think there's a potential for a catch-up trade, but you're definitely not in best of breed here. That's the one thing is we love being in best of breed. And we've got a couple names that are definitely a hell of a lot better breed than Cleveland Cliffs. With that being said, it is, an industrial name. It is the kind of stock that this market likes right now. It is anti-tech, which the market likes that. I think they buy the dip? I think they probably do because of the industry that it's in. But if you're looking at investing, I'd much rather buy a dip on a Nucor or a Steel Dynamics than be going after a Cleveland Cliffs.
Price action. You've had some spikes down, consolidating. We'll pick a nice round number area. Just over 14 was the low. On Friday, 1377. Your low on Friday and Thursday. Let's see 14. Let's see if we can. If the Bulls want to defend this thing, turn it back up. I think you're making you're only you're down 43 cents, but you're not quite getting down to that area. Let's see what the Bulls could do with CLF at the $14 area.
It's that time.
We got a new guest, Luke Lloyd, CEO of the Lloyd Financial Group. You gotta like the LFG in there, huh? For the
you read my mind there. That's why we went with it, man. Thanks for having me today. Joel, Dennis, good to meet you guys. LFG, let's freaking go.
So we got Dennis, we got some new blood here on
I like new blood.
show.
I like new blood.
Yeah. He doesn't know how tough it is to be a guest on our show.
Not tough.
Market
I'm
strategist.
ready for the challenge.
Market strategist focused on macro trends. Man, a lot of trends going on right now. Some good ones, some bad ones. What are you focusing on?
Every single morning in our newsletter, we track three things: growth, liquidity, and inflation. And this, as you guys know, you guys have been in the industry for a pretty long time. You guys are very well known. You guys do a lot of cool things. You guys know we talk a lot about a lot of moving parts and pieces, and it's hard and it's very easy to get involved in the noise and head trash and try paying attention to things that we don't need to pay attention to. So we simplify it by looking at those three things. As long as those three things remain pretty strong, our portfolios remain higher risk. If we start losing one out of three of those, or two out of three, or all three out of three, it dictates kind of the risk in the portfolio. Every single morning right now, the past few days, really, except for we got a little bit of a hit last week in some of the areas like liquidity, but for the most part, growth still remains very strong for this year when we pay attention to GDP. Inflation looks like it's not really an issue, even with maybe some of the growth rates and liquidity in the system. Usually you do see an uptick in inflation because of some of the growth and liquidity. We haven't seen that. And liquidity still remains very, very strong with the government deficit spending trillions of dollars. I think almost $8 trillion in money market funds out there. This dip was a little bit harder last week and a little bit more than we thought it was going to be, because we thought a lot of buyers are going to be there to get in very quickly. We don't know if it's over 100% from here on out, but we do pay attention again to those three things, and those are remaining strong. So we're actually the highest risk in our portfolio we've been in probably 6 or 7 months.
Growth. So growth in GDP, growth in the economies, right? But there's some sectors where there's not a lot of growth, and where you have the haves and the have-nots here. And this market is just with growth stocks. A lot of the big tech stocks, we've seen a rotation out of there. Some of the most wicked rotation we've seen in a long time. Are we getting back to it, to even out that pendulum when, going with growth and tech and AI? Put it all together for us, Lloyd.
Oh yeah, you're seeing a complete mean reversion going on, and this has been kind of a long time away and long time happening too. I mean, I always go back to what we're seeing in the profit margins from a macro side, that we can get more specific with it. But from a macro side, I think profit margins are sitting near like 14%. I think it's the second highest ever in history for what we're seeing in the margins. And then you also have GDP at 53% of income, which is the lowest it's been since like 1949, of that's income and wages and tips in people's pocketbooks. So you're seeing a discrepancy. You're seeing Wall Street make more money. You're seeing the person at home basically take home less of the money as a share of that revenue. We think that trend's going to continue with AI really coming in and replacing some jobs, and AI also adding productivity to the bottom line, increasing profit margins. So what you're seeing is now the second, third, fourth derivatives, I think, of the AI implementation cycles, second, third, fourth derivatives of the liquidity and money printing that we've seen the past 3 or 4 years in the economy. That liquidity spigot has been turned on the most it's ever been turned on in America since in American history. So you're seeing some of that money kind of flow through the system a little bit more than just, I think, the Mag 7 stocks of the world. So RSP, the equal weight index, our portfolio tracks a little bit more of the equal weight than it does the Mag 7, because I think we only basically have one Mag 7 stock, Google. We do have Microsoft. I got hit obviously pretty hard a few weeks back, but that's like a 2% weighting compared to like a 7% it has in the index. Sure. But Google is our main Mag 7 stock that we own. So our portfolio tracks the RSP. So we're very happy so far this year. I think the RSP equal weight's up like 4%. I mean, S&P's up like -1 maybe, or maybe negative now at this point, -1%. We'll see what happens today.
Luke, so this conversation could go in a lot of directions here. I want to take it in this direction because we've done this in the last few weeks here. Is the thought like that, this market for the whole, like I've been saying, I think we're entering the third inning of AI. The first inning was, the last couple of years. We love AI stocks, anything to do with AI. We're just buying, we're backing up the truck, software, it doesn't matter. AI is just going to make the world so much better. Now we're in inning 2 where there's winners and losers, where we're actually seeing some companies, benefiting. Obviously, NVIDIA's and the AMDs and the Googles have benefited very much. And then you're seeing the software names just absolutely get crushed. It's like, oh my gosh, it's going to be jobs. And then to your point that you were just making is AI is going to displace a lot of workers. AI could actually make, Wall Street a lot of money, but maybe cost a lot of money for a lot of people who have good jobs, because we've always talked about blue collar jobs being replaced by robotics. Sure. But now we're talking about white collar jobs potentially being replaced out here. I mean, so we can paint, the rosy picture of like liquidity and the spend is still there, but AI is not going to be good for everyone here. How do the markets process this? Like, where do we want to be? Do we want to be, somewhat like RSP, which is very diversified and equally weighted? Or do we want to, like, going forward, be like just going to the AI winners? How do you position yourself with so many unknowns on where AI is going, where jobs are going?
Yep. So I guess I'll go back to kind of my philosophy of how we approach things with our CIO, Colin Simons. He's got some stats he runs again every morning on those 3 things I mentioned before, but also that risk tolerance dictates if, how big of a portion of our portfolio is actually invested for, say, yearly time horizons, and then what part of our portfolio is invested on shorter term time horizons. So I'd say right now about 25% of our portfolio are actual trades, things we're not looking to hold for very long, but we're trying to capture, that liquidity in the system, or maybe that rebound of the second, third derivatives of AI that we're kind of referring to. And with software down, I think the lows compared to the S&P that we haven't seen since like 2016 or 2017, maybe 2018, in that kind of area. Yeah. A lot of things get very attractive very quickly for kind of a dead cat bounce or a little bit of a rebound relative pretty quickly to that mean reversion. So things like CoreWeave, CoreWeave is a stock we picked up recently that we never thought we'd own. Palantir at 130, I'd never thought we'd be saying we own Palantir at 130, but it's not a long-term 1-year hold. It's kind of capturing some of that liquidity spigot. Take-Two Interactive with GTA 5 release coming up towards the end of this year. AVAV drone technology that's down, I think, 40% back from the top after the Venezuela. They got a big kickback and jumped up after the Venezuela invasion. A couple other FTNT, Fortinet had a great earnings report. Reddit also down a lot. So these are names that we've added in our portfolio the past 2 weeks, and these are not, again, probably 1 to 2 year or 3 year investments. They're capturing that liquidity and kind of that sell-off where some of these become a little bit more attractive, and we could see that, again, mean reversion pretty quickly. So hopefully that answered some of those areas in that direction. But what I will say is AI is going to make the rich richer. AI is going to make the stock market go higher. And then the thing is, in this world, we have to pay attention to is not just the direct impacts of certain technologies and certain things. We have to pay of the secondary and third repercussions of things. What I mean by that is AI starts replacing jobs. What happens? It gets politicized. The top, it doesn't matter if it's left, right. You can't have a whole new thing kind of taking jobs. I don't think it's going to create as many new jobs. Once it gets politicized, what's the government going to do? Try to patch things up with a Band-Aid. So maybe UBI comes back into the equation. Again, not to get political here, but left and right seem to agree giving free money now is a good idea. That was never a historical thing before in history. And giving free money out props up markets and provides stimulus to the economy. So my point is, you almost have the AI productivity boom adding productivity to business owners' pocketbooks. Then you're also going to have the government come in and Band-Aid and patch things up if it does start replacing jobs. So the only pathway I see is the overall markets honestly having another almost roaring 1920s. It's going to be 2020s now.
It's hard to, I think I'm with you, because it's one, it may be bad for, losing jobs, and maybe we go out, and then some people are saying, oh, the unemployment rate could go to as high as 20%. But the corporations are going to make a hell of a lot more money, because you got Facebook talking about flattening their workforce. It's just going to be more efficient. I mean, we had a CEO, I forget who was on CNBC a month ago, talking. He's like, I just got rid of 37 employees because I got ChatGPT. I pay $30 a month, and I got ChatGPT that replaces 37 employees. I mean, their margins are just going to get higher with less labor. But at what point is there a tipping point where if you do start to see the unemployment rate, well, people are going to have less money to spend. So, I mean, it's like there's going to be, I think I agree with you, the market could really roar on better efficiencies. And maybe that's what we're seeing in some of these real economy stocks really moving up, because maybe there will be more efficiencies. Maybe Coca-Cola will make more money.
Well,
maybe Walmart will make more money.
Historically there would be less money in the economy because people lose their jobs. They wouldn't be spending money. But again, this is a different world. And we do live in this world now where the government's learned the playbooks, or corporations have learned the playbooks, or if you watch the new there's a documentary I've been watching, I think Legends of Wall Street on Prime. Very interesting, talking all through JP Morgan, all through the 1920s. And back before the Federal Reserve in 1913, the big banks were bailing things out on Wall Street. They'd go in, the government would rely on the banks to kind of patch things up and kind of put a backstop to things. Then the Federal Reserve was created. That's been the backstop ever since. Then ever since we've gone off the gold standard in 1971, like there's been all this liquidity flooding into the system, which somewhat led to the inflation issues in the 80s, but more commodity and oil based. But my point is 2001, after 2001, 2008, Great Depression, you've learned the playbooks, lower rates, print money, put band-aids on things. So all the only pathway I see is if we lost jobs and people didn't have money to spend in the economy, we would be very quick. Whoever's running things at the time, whether it's a year down the road, 5 years, 10 years down the road, they'll be very quick to make sure that we just kind of bail it out. And that's kind of the path we're on. And Ray Dalio talks about it in his book, Principles of a Changing World Order. And I am a Ray Dalio fan, talking about cycles throughout history and Roman Empire, British Empire, Dutch Empire. All this kind of ends the same exact pathway. And I'm talking, again, probably 50 or 60-year time horizons here. Obviously, there's going to be many ups and downs along the way. But the only pathway I truly see in the end is, stocks only go up. And that's kind of what, the Dave Portnoy kind of way of saying, in the long term, they do only go up for a reason. It's just it's designed that way.
Yeah.
Talking about long-term cycles in the market, you also do long retirement planning for people of different ages, different time horizons, different strategies. This cycle that we're in now, I mean, this long-term cycle they've been in, I mean, we've had our intermediate, pullbacks. They've been, very quick. I mean, how would you, going back to, the market always goes up, but like, how would you characterize this long-term bull market? And what advice do you have for investors that are just afraid of heights up here? Like we just can't keep going.
Well, we've had a bull market. I think I just want to add to that. We've been in a bull market for 17 years. It's a 17-year bull market since 2009, because we can say, oh, we had, the COVID crisis, but that went away in 6 months. We had, some other, the European issues there in 2012. That went away relatively quickly too. We haven't had a prolonged bear market that lasted more than like a year and a half in 17 years. So, I mean, at what point in time are we just generationally due for a good one? So I'm just we're playing devil's advocate with you a little bit.
I love this. No, this is a great conversation. And this is stuff I don't talk about a lot of times when I'm doing these kind of media things. So I'm enjoying this conversation. We were due in 2019, 2020. I mean, it kind of lined up, it seemed like, probably with that COVID crisis that we saw. I'd say the market would probably be 30 or 40% lower than it is right now if we did not have COVID, just because of the influx of money that kind of went into stocks. And again, the amounts of deficits that the government's run that's pumped liquidity in the system at unprecedented levels. I mean, that would not have happened. We would not be here right now. The world will obviously be a lot different. I've been talking about the health kind of side of things. Just the economy would be different if COVID never happened. So the 17-year bull market, I think, what do you define now as bull market? What do you define as a recession? I think the definition of a recession apparently got changed too, even though some of the numbers got revised higher. We did see initially like 2 quarters of GDP growth, and everyone's like, oh, we're not in a recession. So my point is the game seems like it's changed. The numbers have changed. The government's reaction to things have changed. The business expectations and people's expectations of free money and handouts have changed. The world is different, and I think the rules have changed to that game, and you have to play that game by different rules. And I think that's kind of what I'm referring to here is, yes, we could see a recession on the horizon. We could see falling revenues at some point. We could see loss of jobs. But my point to all of this is it's not going to be like 08, 09, I don't think, when you have almost, what does it take, 6 or 7 years to get back to even if you kept it in the market. It's not going to be like the Great Depression that takes a decade or two of just, going through the rough spots in life to be able to get through, to back to where you're at. I think the bailouts have gotten so quick, and you saw that even during the tariff tantrum last year. What we see, a 25 or 20% correction top to bottom, and then we're back to all-time highs 4 months later. I mean, that was a very minimal kind of, it was big at the time, but it was a minimal kind of thing relative to historically what has caused 25% probably corrections top to bottom. But my point is, the market drops can be quicker because of transfer information too, and how involved retail is, and how involved I was trading penny stocks in college on my laptop. I wasn't paying attention in class, right? So the world's changed that way too. So reactions to the downside and reactions to the upside are quicker, and bailouts from the government get quicker. So top to bottoms is what I'm saying. It's not going to last and be as painful as they historically have been because of all the band-aids put in, if that makes sense. So, I think it might last 20 years. You might go another 3 more years from here. We'll have a quick reset, and then we're back to flying again. The only thing I'm long-term concerned about is the debasement of the U.S. dollar. That's something we really need to figure out. And at one point, I'm hoping Bitcoin threatens that, to be honest, because I'm a Bitcoiner as a libertarian kind of myself. It is decentralized now, so it's not doing what's supposed to be doing, what it was designed to do, I guess, be more centralized. But I do think Bitcoin's going $1 million at some point. I'd be picking it up actually below 70. I sold all mine to 70, so I have a Vendetta at 70 price area.
Luke Lloyd, CEO, Lloyd Financial Group, joining us here on Pre-Market Prep with a fresh new perspective on this crazy market. We're going to be dialing you up again real soon, Luke. Thanks for joining us.
I had a lot of fun. Thanks, guys, for having me.
Thanks, Luke.
All right.
I just want to continue on his rant just for a second here. I know he just left here, but it's such a good point. But the one thing I take out of this, and I've been saying this for a long time, 17 years, we've been in a 17-year bull market because the government will not allow the stock market to go down. That is really what we've been driven by. I mean, think about the liquidity that has come in, and then think about what I just said with the capacity ladder here. I don't know if I'm saying that right. Before Lloyd came on, I'll just repeat it here. Like, we're talking about, from a stimulus perspective, one, the president's still talking about issuing stimulus checks, and that might happen because he knows, he wants to win the midterms, and the best way to do that would be give, citizens money. But another $1.2 trillion funding bill, coming in. I mean, we just continue to print. This is bad for the U.S. dollar. It's bringing the U.S. dollar down. But I mean, this has really been driven. The entire last 17 years, hasn't really been driven by efficiency. And that might be where it comes from, the growth is AI efficiency going forward. It's been driven by free money. Just the printing press, open right up. We opened it up during the financial crisis. We started QE, and we never really closed it. We never really closed it. We just continue to print more money. And, when you have, like, if you look at the history of the markets, I've said this before, the history of the markets, stocks go up because population grows. It's all was built on population growth. Now that population has stabilized, in order to continue to grow the economy without population growth, you have to get people to consume more. How do you get people to consume more? You lower rates and you give them more money, and then they consume more. That's all it is. So it's all a consumption equation. I do worry, though, about AI efficiency in the long run, and the market will see these corporates making more profits. So Lloyd's probably right. This probably moves up over the course of the next, while here as we get more AI efficiency. But eventually there is a tipping point where if people are losing their jobs, eventually that's going to show up in consumption. That's going to show up. You can't just keep having the gap get wider. Or maybe you can. Or maybe we're just going to have this world where people suffer on the low end, and then there's rich people on the other end, and that's it. I think that world's going to suck, though.
We are still in earnings seasons, folks. And also just wanted to give a heads up that we are going to be getting our BLS jobs data on Wednesday this week. This is the rescheduled data point from December. We'll be getting our December jobs data on Wednesday at 8:30 a.m. Here's our wonderful earnings calendar preview for this week, put together by Michael Feehan. Thank you, Michael. If you guys want to touch on a few highlights for this week that we're going to be looking forward to.
So a lot of companies reporting. We got better part, I think, 700 or 800 companies reporting. So it is a big week. There's not like the big mega cap names, though. So you're not going to see individual market movers, but there's a lot of retail darlings in here. just looking, open door tonight. That's a retail door. It'd be a fun one to look at, but that's, not really one that's jumping out and being, like one that's going to move the markets, obviously. But you get into Tuesday, get Robinhood. Everybody watching Robinhood. You're going to get into Tuesday. Spotify is interesting, but Robinhood really is the standout there. Wednesday, it's got to be Shopify off the hop. I mean, Wednesday, Shopify, the stock in itself, has just been crushed. 160 to 112 in this software glut. I honestly think Shopify, out of all the stocks this week, probably is one that I actually want to be long into the earnings report, because I think Shopify has been firing on all cylinders. I think they're going to say a lot of good stuff, and I think the bar is on the floor. I think it could have a Palantir type rally where, you had the pop, and I went long Palantir into the report because I was like, you know what? This company's going to say a lot of good things, and the bar is really low. And the stock went from 148 to 166 or something on the earnings. I think you can see the same thing. So I'm thinking about Shopify actually going long into the report. Not saying I'm buying it today, but long, into it. And we'll see where we go, because 2 days is a lot in this market. We get some volatility, and we're selling off here right now. But I do think the bar is really low for Shopify here. I think they'll blow it away.
All right, let's do a little rating the ratings, folks. Rating the Ratings is brought to you by Fly, your place for over 1,000 breaking news articles daily, real-time alerts. Their new Fly Pro platform is what Dennis and I have been using for quite some time now. The new platform is relatively new, but we've been big fans of the Fly for quite some time. Let's start off here with our first rating. Triple D, you were looking at Oracle, upgraded to buy by D.A. Davidson.
Yeah, contrarian call. Oracle's in the gutter. We've seen it get upgraded a couple times in the last month or two, and the stock just rallies for a day and then sells off again. The stock is the most oversold stock of them all. Joel and I both own this long-term account. Unfortunately, here it's been, obviously the victim of, one, they hate AI spend here now. You saw what happened with Amazon when they announced $200, extra $1 billion worth of spend. They punished the stock. So, I mean, this is why the company is down. So let's read the note here a little bit. If you have some color, you can put it on the screen here. I'll just read a little bit from the note as well.
Yes,
it's Gil Luria upgrading the stock to buy $180 price target. So basically where it was 4 days ago, which how much it's went down. We believe that a revamped OpenAI will return to its position as Google's top challenger, and with a fresh stack of capital, be able to live up to its obligations this year, including to Oracle. We believe that this will remove the biggest concern for Oracle and are upgrading shares to buy from neutral. So they're talking about a revamped OpenAI running Oracle. We know Oracle's been moving with OpenAI, as we see, OpenAI headlines and, money coming in there. Oracle's been moving with it. I don't know what to say on the stock anymore. It's going to be, at this point in time, it's a screaming buy, or the company's just spent too much and it's got a whole world of trouble and they're going to have to do more equity raises, which they just did. So is the excessive spend that Larry Ellison is doing here with Oracle, obviously, I don't know the case. I don't know if Oracle with the excessive spend is a buy, or if it's, going to continue to be punished for it. At a certain point in time, maybe it is, but if they have to continue to raise cash, I don't know. I honestly don't know about this stock. It's really tough.
Not financial advice, but average down on this one on Friday.
You did. You
average down?
Yeah. Yep. Don't frown, average down. So,
I mean, you can do it. I don't know. Like, it just doesn't go up on anything. I mean, yeah, it's up $7 this morning because it got an upgrade here. I just, the way the story goes every single day is it gets a piece of positive news, it pops 3-4% overnight, and then by the end of the day, it's red. I mean, this is just what it's done again and again and again. It seems way overdone. It seems like, this stock is now priced where it was before it even had any AI exposure. It would have been better if they would have did nothing with AI. But then software is getting hit now too, so it's there too. This is like the eye of the storm stock. But, sometimes when, it's a worst out, and it looks like, there's no, if you close your eyes and buy, 5 years later, you're happy. It might be the case here. I'm just not convinced. That's why I have not averaged down.
Yeah, long-term play, not worried about next quarter, second quarter, third quarter, looking at it. I mean, it's the AI thing, they got overhyped and took it to I think this is as ridiculous as this was at 340. I think it's more ridiculous at 140, 150. I think they're just the overshoots. Where fair value is in this, I mean, the company was doing okay before that. I know softwares got hit, but that's it. I mean, buying on weakness, certainly a lot chasing this one. So I'll be limiting my comments here on Oracle.
I can't figure it out. So I'm just going to say I don't know at this point in time. I'm shocked. I would have never thought that this stock could go from $300 to $149. But back in October, we still loved OpenAI and we still loved everything to do with AI. And AI spend was being rewarded. Brentster, you've talked about this, relentlessly on Stock Trader Network. And now literally Amazon said everything right except they put more AI spend down there, and the stock falls 10% because of excessive AI spend. Oracle's spending so much that they've got to borrow big time money. That's where, they are of excessive spend. Oracle is the Oracle of excessive spend. So until the market starts rewarding excessive spend again here, the stock probably remains in the gutter. And then I just think I wrote it down here today, and it's hard for me to come and buy stocks that are making new lows here. It's one thing, they go down, they dip, they're in uptrends, they're still holding up. But when they're just breaking down every single day, I'm not going to be a hero. I need the stock to stabilize until I add more. I'm not going to try to get the bottom on this one.
Let's do one more here real quick. We're going to talk about the Roblox upgrade to buy at Roth Capital. A little color here. The firm is more positive on shares due to Roblox better than expected 2026 bookings guidance and over 20% bookings growth outlook annually over the next several years. The company has a strong, sustainable, virtuous circle with improving development tools that are producing higher quality games. The analysts say in the note, Roth sees an attractive valuation at current levels here. I want one of you guys to actually rate this rating. Is this a chasing rating here? What do you think, Triple D?
It's a contrarian call, not chasing at all, because Roblox has been in the absolute gutter. And I like a contrarian call, a good contrarian call, because it shows the analyst has guts. It doesn't mean I'm necessarily buying, and in this case, I actually sold it because I sold the Roblox pop on their earnings. I had bought it. It was actually an R in my burr, and the stock, has just been punished with software. And we talked about this. I said if this pops into the earnings, and we thought it might, Michael Pachter was on and said on our show, and he thought the bookings were going to be really good, and it was a great call. And he thought the stock would pop 20% on the bookings. It did that. So great call by Michael Pachter there. It was the initial, I had bought it ahead of that because Michael Pachter thought, that this company was going to actually, and then obviously software has just been punished. I mean, software has been hammered, and now it's in the gaming. It's been everywhere, and, it's been a victim of that. But I do think, the trend is not your friend. There's so much overhead supply. And here's a stock that, I can cut the loss on with a 20% pop. What I do think is, when you've made a wrong call, and how do you know you're wrong? You're losing money, and the market bails you out with a 20% pop on earnings. I think it's more time to maybe cut the loss and move on. So I took a small loss. I bought it at 81. I think I averaged out around 72 or something. And I'm just out of it at this point in time. So I still have Baidu. If you're following at home, I still have, I never had the regional banks, which I should have, and I was one of the R's. And then my other R was Roblox. What was the other one? I forget what the other one was.
Was it
Rocket?
Rocket. Oh, Rocket. Yeah.
I did lighten up some of my Rocket into that recent pop here too, because again, I didn't like the P. So what you have to do as a trader is, and it's hard to do these acronyms and say, I'm just going to buy this stock and hold it for a year. You can't do that as a trader. You can't do stuff like that. You got to be new information. You got to be adjusting. We've seen, this market change so rapidly. And that's why Joel says, I hate this game, because you're making me, make a call. And then a year later, we'll see how we did on that call. It's it is the hardest game ever because stuff changes. I mean, who thought, when we started the year, that software IGV was going to fall 30% in the first month? I mean, that's a game changer for all these names. So I just think I don't know where we're going, and I don't know if AI is correct, and I know we're going overtime. I don't know where we're going in the third inning of AI here, and maybe software is all screaming buy, but holy crap, these stocks just got so punished here I'm at a point where I don't know. Like, and nobody knows, but I don't even like. I'm not even comfortable making a call at these stocks. I don't know what's happening with Oracle. I don't know what's happening. And if Roblox is going to be the same thing, they're going to punish GameStop, which we've said that the potential is there to do that. It's hard to just come in here and buy the dip.
All right, folks, we're going to wrap it up here on this Monday. Off 15 handles, we tried to rally a little bit to go back green on the session, and that failed. So I don't know. That was a big old rally on Friday. We were adding to the gains, a little bit of reversal. Keep your eye on your closes, folks, from Friday. So it should be good levels starting in the red. But once again, great crowd in our chat. Thanks for all the great ideas. We'll be back with you tomorrow morning, 8 a.m.